Hi there, welcome to Alternative Investing. I'm Andrew Bell. Here with me, my co-host David Kaufman, president of Westcourt Capital. Great to have you here.
Always a pleasure to be here.
Well, on this show, David and I explore investment concepts outside of the traditional realm of stocks and bonds. It's for investors like you who may be sitting on cash, maybe quite a bit of it, looking for alternative places to put your money, places not in the public markets, but in funds or products that fly a little more under the radar. Now, on this show, we often talk about alternative investments that are available only to an accredited investor. In other words, people with big bucks. But today, we'll be looking at what's available out there for the masses, the non-accredited investor. David, remind us, before we get into this, what's the rationale behind alternative investing itself?
Right, because just because someone is not an accredited investor doesn't mean that they're not trying to achieve exactly the same thing through branching into alternatives that a more wealthy investor would be. So the four main things that we're always looking for and we speak of every week, number one, decorrelation from the public markets. So that doesn't mean that it's supposed to be opposite of the markets. It means that when the markets go up or down, that alternative investments could be flat or up or down, but that they won't be directly linked. The second is absolute returns. What does that mean? Very simply, positive returns. That it's not relative to some kind of a benchmark. I did better than X, Y, or Z. It's that every year I made 6 to 8% or something along those lines, and that's what I'm after. The third are hedge strategies, true hedges, which reduce volatility. Now, of course, when you employ a hedge, you're also going to lower how far you hit the ball out of the park, but the idea is that you get a lot more doubles and much less volatility, and volatility is risk. Finally, inflation protection. One of the downsides of publicly traded securities is that they don't necessarily provide a direct protection against inflation, whereas there are a number of different alternative investments, which we've discussed, which tend to provide a pretty direct correlation to inflation, meaning that as inflation goes up, so too does the value of your investment.
Some of these alternative investments, they use risky stuff like shorting, and for that reason, they're not available to the general mass of investors. What is an accredited investor? To explain that to us.
Okay, so an accredited investor in Ontario is the highest bar, and so that's what an accredited investor comes from, is typically in Ontario, where it essentially means that they have over $1 million in investable assets, not in net worth, so your house doesn't count. It has to be in investable assets, or there's other rules as well that they have over $300,000 with their spouse and annual income each of the last 2 years, and there's a number of other exemptions that come along with that, such as a net worth over $5 million, which probably implies that you have $1 million in investable assets. But if you don't reach any of those, the only other way to invest in the exempt world is by putting $150,000 into a single investment. And what I often think is that if you aren't accredited and you can come up with $150,000, you probably should be diversifying and not putting it into one alternative bet, no matter how conservative it appears to be.
One thing we're going to get into on this show is that there are options opening up for non-accredited investors.
That's right. That the options that we've discussed up to this point that are available only to accredited investors are typically the hedge funds, private mortgage funds, private equity, and also private high-yield debt. You keep hearing me say private because the fact that it's not publicly traded means that it falls in the exempt market. And those are not necessarily more risky, but because they're not what's called prospectus-based, that means they're not available through public means, which makes them available only to accredited investors. So now we turn our focus to, are there publicly traded vehicles which allow the everyday investor to access some of those strategies and achieve the things that we talked about at the top of the show, that decorrelation, inflation protection, absolute returns? And there are. There are publicly traded options, and the only thing that I would say is that although that they provide certainly exposure to alternative investments, they tend to be very expensive, as are all retail products. So we have public REITs. We have mortgage funds and income funds, and some of those income funds are wrapped in what are called swaps, which are very tax efficient. We'll be touching on that later. In order to protect the downside, we have principal protected notes and seg funds, both of which have been around for a long time, but they provide that internal protection, which makes them sort of alternative-like. And then finally, you have real return bonds, so that if you're trying to achieve inflation protection, for example, you could always buy a real return bond, but in the interest rate environment in which we find ourselves, that's not going to be enough for people who require yield in order to live their day-to-day lives. That may not be enough to supply them with that kind of revenue.
Well, those are the options for non-accredited investors. We're going to stick with this theme. Coming up, our look at alternative investing for the non-accredited will continue. We'll talk to an expert for more on all the options out there for people interested in this part of the market. Don't miss Ken McCord, president of Alpha Pro Management, next on BNN. Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. And today, of course, we're talking about alternative investments that are available for people who wouldn't be considered accredited investors. Well, let's talk more now about the options out there for people from all walks of life who are looking for these alternatives. David and I are joined now by Ken McCord, president of Alpha Pro Management. Great to have you here.
Thank you. Nice to be here.
Just remind us what Alpha Pro does.
Alpha Pro is Canada's sole provider of actively managed ETFs. So we provide active portfolio management inside an ETF wrapper, which is generally low cost, very efficient structure to deliver to investors.
Actively managed ETF sounds like an oxymoron to me. So these days, everyone who hears ETF, which is everywhere, thinks ETF means passive. And here you are talking about active. So is this like a mutual fund? Explain.
Mutual funds have grown to a very big size these days, and mutual funds provide both active and passive in a regulatory legal structure called a mutual fund. ETFs do exactly the same thing. Only up until recently, though, ETFs were only able to put passive strategies inside that ETF wrapper. Recently, we figured out a way to put active, traditional, managed strategies inside that exchange-traded fund wrapper. And to us, an ETF is simply a better delivery mechanism for any kind of investment strategy, whether it's active or passive.
Now, it's going to trade on an exchange.
Yeah, all ours trade on the TSX. Yeah.
And you're not going to go to a discount from the net asset value, which was like the curse of the closed-end funds?
The difference between a closed-end and an ETF is in the name. Closed-end is closed. There's a fixed number of shares outstanding. And because there's a fixed number of shares outstanding, sellers have to find buyers, buyers have to find sellers. And as a result of that, closed ends can trade at very deep discounts to their true NAV. An ETF is different. It's an open-ended structure. Units are being created and destroyed every day, all day. And as a result of that, you can have an ETF that trades right at net asset value, give or take a bit offer spread, of course, but ETFs generally trade right at net asset value.
So before we get to some of the specific strategies, what people talk about a lot today is that the best managers follow the fees. So you find the best managers, so the critics would say, in the hedge fund world. And then you'd find the next best managers in the huge mutual funds where the MERs can be quite high. And where does that leave the ETFs? When you're out doing an actively managed ETF, you need to find a manager to execute that strategy. So where does that leave you in the competitive world of finding the best ones?
I'm getting phone calls every day, David, by world-class money managers who want to be on our platform. And the reason is pretty simple. I see in the mutual fund world investors deciding 2.5% to 3%, they're not going to pay that anymore. They're going to vote with their dollars, and they're going to move to low-cost structures, without a doubt. Portfolio managers under a 2.5% to 3% fee schedule look bad. If they beat the index and then we charge 3% on their performance, all of a sudden they don't look so good against the index. If I can deliver a product that charges 50, 60 basis points,
so 0.5%.
That saves face for the portfolio manager. They can put great performance on the board, and then I only pull back 50 basis points instead of 2.5. It's going to make my portfolio manager look a lot better than a portfolio manager at a mutual fund company, and as a result, we'll get more assets in, and they'll get more compensation.
And then do you deal with, because there are sometimes more specific strategies, do you deal with smaller capacities? Like what would a normal size be for a managed ETF?
Well, they can go to billions. The largest in the world is managed by PIMCO down in the United States, the biggest bond manager in the world. They've got $1 billion actively managed ETF. There is no size constraint. It would have the same constraint as a mutual fund would. It's only constrained by the liquidity of the underlying securities. So without a doubt, we could get these ETFs to hundreds of millions, if not billions.
And speaking of liquidity, talk to me about the liquidity. So with mutual funds, some people don't realize this, but it's intraday liquidity. At the end of the day, they strike a NAV, and that's what you get if you've decided to redeem.
Right.
How does that work with an ETF?
ETFs you can buy and sell intraday just like a stock. So
much
better
flexible.
liquidity.
Yeah.
And we noted this yesterday. You know, the NASDAQ had a great run up early in the day. So if someone owned a NASDAQ-related mutual fund and wanted to sell at 10 a.m. to take advantage of that, by the end of the day, the NASDAQ was in the red. And you would have lost money, and you would have had to sell at that lower price. With an ETF, if you want out at 10 a.m., you're out at 10 a.m.
When the public come to you or when you talk to potential clients, what do they ask you for? What do non-accredited investors want?
Right. The first thing is lower fees. The day of 2% management fee and 20% of performance on most alternative strategies, I think those days are numbered. So to be able to get that through a different kind of structure where they're paying lower fees, that's critical. The second thing is real diversification. Without a doubt, we're seeing a lot of convergence across asset classes, geographies, and market capitalization. Things that are supposed to go like this are going in tandem. So people want real diversification, and alternative strategies can deliver that. People want that. Returns that are not correlated to the equity markets. They want income with low risk. You know, we're in a period of historical lows on interest rates. They want lower risk, higher income with low risk. And finally, tax efficiency. We're getting a lot of demand for more tax-efficient vehicles.
So when you have a tax-efficient vehicle, that obviously adds cost. I mean, you're getting a return on that cost. When you have a publicly traded vehicle, that adds costs. So when you put that together, what are the limitations of having a prospectus-based product versus, for someone who may be accredited, for example, versus going directly into an OM-based fund?
Right. Well, from a distribution perspective, and who can buy it, there are no limitations. Anyone can buy it as long as it's prospectus offered, and you don't have to pass a net worth or an income hurdle, and you don't have to fill in reams of documents either to prove that you're worthy. The limitations are really from a regulatory standpoint, and the regulators, if they are going to offer a product or allow a product with a prospectus to be sold to anybody, the regulators want to make sure that certain thresholds on the investment side are kept in place. So, no leverage. Unless there's some kind of exemption, you're not going to get leverage on a public traded alternative strategy. And secondly, you can short, but only to small degrees. Generally, it's around 20% short selling is allowed on a publicly traded vehicle or a public issuer. Anything beyond that would require special exemptions, and they're not giving those out very freely these days from the regulators.
So give us an example of some new products that have come out in this area, allowing non-accredited people into the alternative space.
Right. So there's a lot coming out in my world, in the ETF world, and I won't speak about the mutual fund world, but in the ETF world there's a lot. A sister company of mine, Beta Pro, have got what we call spread ETFs, where you can take advantage of the relative change from one commodity against the other. For example, they have an ETF which is ticker symbol HON, which gives you a long exposure to crude oil and short exposure to natural gas, all in the same package, or the flip-flop, where you're long natural gas, short oil, all in the same package. And you're really trying to get the relative performance of the two together. No matter what direction energy is going, you're just trying to capture the difference there. Claymore is coming out with an ETF that gives you exposure to a managed futures strategy, which I think is a really smart one.
We just talked about that, yeah.
Right, yeah, smart idea, and I think there'll be a lot more of that coming out in 11. And then my company, Alpha Pro, we've come out with a strategy that delivers exposure to floating rate corporate bond portfolio, which you couldn't really do on your own unless it was sort of synthetically recreated through an alternative strategy.
So that's when we recently had the folks from Claymore on to talk about the managed futures ETF, or to talk about the Alpha Pro product that you just mentioned. One of the sort of determining factors, from what I understand, in an ETF is that you have to lift up the kimono and tell everyone exactly what you do. So does that give you a competitive disadvantage when you have the special sauce, which is the way to make money, that you have to show the whole world how you just did that?
Right. So what we have to disclose are specific objectives and strategies of the fund. That's in the disclosure document or the prospectus. We're obligated to follow the strategy. We are not obligated to show the individual securities in the portfolio on a day-to-day basis. We are regulated the same way a mutual fund is regulated. So we have to provide disclosure on a quarterly basis on top holdings, and on an annual basis, complete holdings.
So that's it. But that's weeks later, so
yeah.
it's not a problem.
So it's not. We don't necessarily have to lift the kimono up.
So I can only follow you in my rearview mirror.
Correct.
Basically.
That's right. Yeah, the same requirements as a mutual fund.
Now, obviously, there's a problem of complexity here. You're getting into structures, and there can be a jack-in-the-box whenever you start putting structures on, regulatory or tax.
Sure.
Is this going to be a problem?
Well, I think as long as they're done properly and as long as the regulators approve of it. I mean, that's the beauty that offering some strategies inside a prospectus offering like we do, is the regulators are there in place to pass judgment on these strategies and to ensure that investors are protected, that the strategy put in place passes merit and it's worthy of public offering and can be sold to anyone, even if they don't have the financial or intellectual means of getting those performance.
Part of the structure that we see, that we alluded to a little bit earlier, very popular today in the income-based funds, is the swap.
Right.
And without getting into how exactly that works, because we could do a whole other show on that and many others,
right.
How expensive is it, and what are the chances that this fairy tale will come to an end one day, that you can, with fairy dust, turn what would otherwise be taxable income into capital gains or even return of capital?
I'd hate to speculate on what the CRA is going to do, but for now, let's just talk about this structure. It's a structure that does a number of wonderful things for the investor. The cost of it's around 30 to 35 basis points and worth every penny, without a doubt, because some of the things it allows the investor to enjoy are, number one, the compounding of returns on a tax-deferred basis. So quite often investment vehicles will pay out distributions on a quarterly basis. A lot of people don't like distributions because they have to pay tax on it. So a swap allows you to defer that and compound it within the structure without paying tax.
So without paying tax from the outside, you can you can let it roll.
You let it roll inside on a tax-deferred basis. You pay when you eventually leave the structure. Foreign income is taxed. There's obviously a foreign income tax withholding, and then once that income arrives in Canada, it's taxed at highest marginal rates. This structure allows you to recharacterize that income into a return of capital or capital gain tax rate. Very, very beneficial. On income strategies where people actually want to get monthly or quarterly or regular income, this swap arrangement, this overlay allows you not only to defer the tax on the income. So you're getting income, but you do not have to declare that income the year you receive it. You're deferring it, but you're also recharacterizing it from a higher tax responsibility to something like capital gains.
Right. So it might lower my cost base, but I pay that tomorrow, and even then it's only a capital gain.
Right. I defer it, and I lower the rate applied to it.
Got to take a break there, guys. Coming up, but you can see Ken is a very shy, retiring fellow without much to say. Coming up, it wouldn't be the holidays without looking ahead to what's coming up in the new year. Now, Ken has very kindly agreed to stick around. He'll talk about the emerging alternative trends that are on the horizon for 2011. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital. Time now to look ahead at what could be in store for alternative investors in the new year. And, of course, also joining us, Ken McCord, president of Alpha Pro Management. Ken, can I start with you? In alternatives, what do you reckon people are going to be doing in 2011?
Well, I think that the same things apply here. People are, the demand for income is insatiable right now. People want yield, and they're looking for different ways to get yield. They don't know how to do that. And companies like us are trying to deliver that to people using alternative strategies and synthetic approaches to delivering yield. Tax efficiency continues to be an important theme. And again, this notion of real diversification, where I can deliver returns to an investor that are not correlated to an equity market. Those are the three big themes, I think, for 11.
And so where do you think we're going to be heading with fees generally, just to keep on the theme from before the break?
Yeah, well, look, fees have started mattering in the last 10 years. Back in the heyday of the mutual fund world, 80s and 90s, the S&P went up 17% a year for 18 years. Fees didn't matter. No one cared if they paid 2.5%, 3%. Didn't matter. People care now. You're paying 3%, you're not going to sell a thing. And in a world where we're not really getting any returns over the last decade, paying a lot of money in fees is not going to work. So that's where I think one of the reasons ETFs have boomed so much, because they're charging 50 basis points when mutual funds are charging 2.5. That's I think, really critical. And so I think the mutual fund companies have to really reconsider that. The other thing I see is that this notion of trailer fees, where you're paying an advisor a fee that comes out of the fund, that's going away. It's gone in the United Kingdom. It's gone in Australia. It's going away in the United States. I think it'll happen here in Canada. And should it go away in Canada, Advisors will do everything they can to protect their margin. They will not do mutual funds. They'll do ETFs, which allow them to protect their margin.
So, Ken, way back in October when we talked about asset allocation, we discussed this notion of the 60-40 equity to fixed income split that sort of is, by default, sort of the Canadian approach. Mm-hmm. And what we learned then when Jim Bull was our guest that day is that he told us that that's not how it is in the rest of the world. That's pretty much a homemade, Canadian-made product and an idea. And if you were an advisor in 2011, talking to your client, and you looked out at the landscape that we're presently faced with, do you think that 60-40 is still going to be the starting point or the end point, or not at all?
I don't think it should be any point, really. I mean, I agree with him that to me 60-40 doesn't matter. Look, we've had a fantastic bull market in equities from 82 to 2000. The last 10 years have been awful. I think we could have another 5 years of going nowhere in equities. So being 60% exposed to that doesn't make sense. And some would argue that we're at the end of a 30-year bull market in bonds as well. Mm-hmm. And I don't know that you want to be 40% in fixed income either, because if we get a spike in rates, your bond portfolio, which has looked great for the last 30 years, is going to get hammered. So people have to look for alternative strategies if they're going to succeed over the next 5-10 years in a world that's going to look a lot different than it did in the 80s and 90s.
Now, we're seeing big, sophisticated institutions buying things like toll roads, moving out of the stock market. Are we going to see more of that?
For the institutional investor?
Yeah.
Without a doubt, yeah. Institutional investors are definitely looking for that real diversification that I talked about. They don't want to attach all of their performance to the equity markets. They're also looking for liquidity, though. That's critical. A lot of institutional investors who got into alternative strategies in the past, maybe they did well with them, but when the markets crapped out in sort of 08, they got locked in. They could not pull their money out. And that was tough for them. And they're going to look for things that are liquid, like an ETF is a great example, where they can get their money out within a day.
You know, it was interesting a couple of months ago when we had Peter Hayes from KPMG on to talk about what it is that the institutions are looking at. There were two things that were, one wasn't surprising and one was. What wasn't surprising is that he talked about not only are the 2 and 20 days over with, but transparency is everything. And transparency can really be on two levels. You can either have managed accounts so that you say, where is my money today? And the other transparency that you see is just if the accounts are pooled, it's where is our money today? And the thing that was surprising to me was that on both the buy side and the sell side, from an institutional perspective, that their 2-year report showed that neither side wanted more regulation. Why? The idea was that for the people who are following the rules, all the extra layers of regulation
just complicate things.
Yeah, complicate things and add cost. And for the people that weren't following the rules, well, they're not following the rules anyway, so the extra regulation doesn't really save anybody.
Mm-hmm. The transparency allows the industry to almost self-police. If you offer, as a manufacturer, full transparency, your clients aren't going to invest unless they're happy with the exposures you've got them in. So it's self-policing to that extent.
Right. Ken, we'll have to leave it there. Ken McCord of Alpha Pro and, of course, David Kaufman of Westcourt Capital. That's all the time we have for on the show. Remember, contact us at alternativeinvesting@bnn.ca. Thanks very much for watching.